All right, we're alive. How's it going, guys? My name is Brandon B. Dixon. My NMLS is 1541210, and I have my co-host here, Anthony Gallup. Um, you want to go ahead and introduce yourself first, Anthony, and then let's get the introduction out of the way. We have a special program for you for the webinar. I'm glad y'all tuned in. We're going to talk about all the options for zero down, 100% financing. So your path to home ownership. So, Anthony, I got you queued up.
All right. Yeah. Welcome, guys. We have a really good show for you guys today. We're going to be diving deep into zero down 100% financing. I know that's a really big topic for a lot of first time buyers and buyers out there. My name is Anthony, aka the Mortgage Prepper. Not like a survivalist, but more like a strategist. I help people empower themselves to secure their own legacies through prepared home ownership. You can reach me at themortgageprepper.com. And you can also find me online at all my socials at The Mortgage Prepper. So we're here to give you guys the real details on how you can get into a property with zero down. Stay tuned and let's jump right into it.
Gotcha. For this is your first time tuning in, my name is Brandon B. Dixon. My NMLS is 1541210. It's at Billionaire Loan, also on all social media. Also, you go to my website, www.applywithb.com, if you want to book me for a consultation or if you want to apply for a mortgage. You could also call me 832-753-5541. You can call me 24/7 or text me. Also, you go to my website, www.brandonbdixon.com. Don't forget I'm a licensed realtor as well. So if you want to list your house, if you want to lease a property, give me a call on that. HoustonCondoSales.com is up and functional now. So if you want one of those badass condos that's out there, we're going to teach you how to get one, and we'll teach you how to get one with zero down financing here. Last but not least, thepowerofownership.org. Don't forget our podcast, The Power of Ownership, airs every Monday night at 8 p.m. Catch us live, or if you catch us on a replay, you go to powerofownership.org and catch all the episodes, the previous episodes. All right, so let's get down into the nitty gritty. We're going to talk about 100% financing today. And I hope y'all ready, because this is one of the biggest topics that I get when I do consultations, or when I get leads, or when I talk to new people about home financing. Either A, they're looking for, down payment assistance, or they don't know that they're eligible for down payment assistance or what's required. They don't have a lot of knowledge on it. So they always, first of all, they either ask or have issues where they have problems coming up, like, hey, man, why don't you do down payment assistance? So a lot of people don't know about it. So we're going to talk about it a little bit today. Let's get it going first here with the slideshow. Now, actually, let's start it. All right, so we're going to talk about zero down home ownership, 100% financing, down payment assistance. We're going to talk about VA, and we're going to talk about USDA. The down payment may be zero, but the strategy has to be complete. So a lot of people don't realize that. So let's get it going. I'm going to do the first slide here. All right, so what does zero down really mean? Zero down means no borrow funded down payment, not necessarily $0 due at closing. So let's talk about that a little bit. So we're gonna get into that, because a lot of people think it's similar to a car, where you could go in there with just a signature. So whenever you're buying real estate or buying a home, you're going to need some money, but we do have programs to give you 0% down payment. So, but there are other expenses that go toward buying a house. And Anthony, he's going to jump into that here in a second. So we want to go ahead with the next slide.
Yeah. So like Brandon said, there are other costs. A lot of third parties are involved in the home buying process, which they need to get paid as well. And sometimes they need to get paid before you get to closing, right? So there are four main paths that can help reduce the upfront cost to get into home ownership. Obviously, down payment assistance paired with an eligible first mortgage. When we say first mortgage, we're talking about the traditional mortgages, right? The FHA, conventional, either USDA and VA are what we consider the traditional first mortgages, right? Now, also, we have nationwide assistance programs through approved lenders. So certain lenders participate with certain programs that are either nationwide or state funded. And if you combine those, you can usually get into something with 100% down, right? Or 100% finance. VA financing is probably the best loan program out there for good reason. All of our military members deserve to be able to have the dream of home ownership with very little out of pocket, right? We all know that they deserve that. So VA financing for eligible service members, veterans, and their surviving spouses, oftentimes. And then you also have USDA financing. This is more reserved for people that are buying properties in rural areas. You're not going to find something smack dab in the middle of the city, but for these suburban and outskirt rural areas, these properties are usually USDA eligible, as well as certain household income limits can be imposed. So if you're over a certain limit, you may not qualify for USDA, but USDA and VA are two better 100% financing options that don't require being combined with a assistance program, either nationally or state run.
Right. So zero down is not the same as zero cash to close. I want to make that very, very clear. A lot of people think that down payment assistance means that you're going to come out of the equation with nothing out of pocket. And that's further from the truth. So with down payment assistance, your down payment could be covered. That could be zero. But however, just like you buy a car, there's tax, title, and license. Similar is how when you buy a house, there's title fees, there's taxes, there's things that has to be in escrow as well. Those are called closing costs. So you ultimately are responsible for them. However, your realtor can negotiate the seller paying those for you. But there are other costs that's associated with buying a house. That's not just the house itself. There's taxes, there's fees, there's other things as well. Prepaids. Let's talk about prepaids. Prepaids include, on here it says tax and insurance. That's partially true, but that could be rolled into your closing costs. But the prepaids that I warn customers about are the appraisal. We'll talk about the VA portion of the appraisal later on once we get to VA, but appraisal just depends on your area. It could be anywhere from $550 to $750. Just depends on the area. Also, you need inspection. I would highly recommend that if you're buying a new house, that you get it checked out, just like a car. You wouldn't check under the hood if you buy a used car. So always get an inspection from a third party. Also, there's what's called earnest money and option money. Earnest money is 1% that usually the seller requires. It's all negotiable, but usually the seller wants about 1% in escrow that you put at the title company just to show that you're serious. And that actually goes towards your down payment. If you get down payment assistance, that could carry over to closing costs, so on and so forth. But that's part of the prepaids that you got to do, as well as you need get your credit report ran. So there is no true zero dollars now. You do need some money to buy a house, but however, getting down payment assistance can really reduce those costs. And then last thing is the credit, seller and lender assistance. So seller, like I said earlier, seller can help you out. Lenders sometimes, most lenders won't, but lenders sometimes can help you out. Just depends on if you get a rate that is rebated. So let's say, for example, you might go with a higher rate, and that rate comes with a surplus or a rebate. That can help you towards closing costs as well. So, but again, is zero down is not zero out of pocket. So it does help you out tremendously, but it does not mean that you come away with just signature. We'll show you later on. There's a formula for you to do that, for you to get your money back at closing, but we'll talk about that a little bit later.
Yeah. So again, down payment assistance comes in many different forms, right? So there's the typical grant, which is the most popular option. Everybody loves grants because that money it's I want to say free money, right? But it does have certain conditions that have to be met. Typically, there are income limits. There are oftentimes location limits. There are oftentimes price limits, right? So Grants are probably one of the most popular options because there's really no repayment or offset of the interest rate when it comes to getting a grant for down payment assistance. And then you have what's called a forgivable second lien. So your first mortgage is what sits at the first position. Sometimes there are assistance programs that will give you whatever is required for that down payment. So for example, if you're using an FHA loan, the minimum down payment is required to be 3.5% of the purchase price. If you get a forgivable second, they will give you that 3.5% at the very least as a second loan. So it's hiding below that second loan. So what ends up happening is that when you go to sell the property or refinance the property, you have two loans attached that have to be satisfied. Okay. And then there's also what's called a deferred second, which means the repayment may wait until the sale or the refinance or a payoff. So there is no immediate requirement to have that satisfied. Now then we have what's called a repayable second. Repayable seconds are a separate payment attached with that second lien. So it's just like the first one where there's a second lien below the first, but now there comes a small payment, right? Oftentimes there's an interest rate associated with that, and there comes a small payment that's added to your total payment. So it does increase your payment. And the one thing you want to keep in mind, here's the general rule of thumb I tell everybody. There's no such thing as true free money. There's always a give and take. So if you're taking these assistance programs, understand that oftentimes they come with slightly higher interest rates, a little bit more closing costs because sometimes there's another loan to be processed, which is the down payment portion. And then oftentimes there are other restrictions on what you can do or how long that loan stays hiding in the background before it's forgiven, if it's forgiven. So keep in mind that down payment assistance is a great option to get into the house, but there's always a trade-off.
Right. There is no such thing as a free lunch, right? But it is good in certain situations, So let's talk about how FHA plus assistance can cover the gap. All right, so FHA first is typically 96.5% loan to value, right? And so that means 3.5% of the money comes out of your pocket. With the assistance, we can get sometimes up to 5% with assistance, which could cover that 3.5% that you're responsible for, plus another 1.5% that could go towards closing costs. Down payment is permanently covered, depends on the program, like Anthony covered. So some are grants where it's totally forgivable, or some you pay off at refinancing, or some have small payments, but most of them are grants, that we usually use. So that's permanently covered. You don't have to repay it a lot of times. Closing costs. So if you select 5% 5% assistance, sometimes that 1.5 could go towards those closing costs, and that could actually significantly reduce your closing costs. You couple that with seller concessions, that's the path what I was talking about earlier, where you could get a lot of your prepaids back. Now, you can't get paid to buy a house. However, all the money that you invested in the house, you can get back. So if you have a land yacht, which I'm from Louisiana, which means extra, so if you have extra funds at closing, you could get refunded all the money that you put into the house, which means that your appraisal, your credit report, your everything that you put in, you could get that back. But you can't get money. You can't get paid to buy a house. So that either has to go into a principal reduction, you have to lower the cost, or you could buy it down the rate with a surplus of money. So final review. I don't know what final review means on there, but we're gonna keep on rolling. But the final review, the final document, which is the closing document, or CD, or closing disclosure. Usually we have that balanced out, and we'll let you know at a couple of days before we close exactly how much you have to bring to close, if anything. All right. So let's see, what's the next one? All right, this is an example. Go ahead.
Yeah. So this is an example of one of our national programs that it's a very popular program. A lot of places will offer this. They're the Chenoa Fund, which is available just about every state except for New York. It's an assistance program that gives you anywhere from 3.5 all the way up to 5%. Again, what Brandon said is that when you take a little bit more, you're also giving a little bit more in either higher interest rate, more fees, right? So there's always a catch. Obviously, you see 5%, you're like, why would I not take more money? But there is a trade-off for that. So that 5% means that you can now take the 3.5 to take care of your down payment, and whatever's left over, you can put that towards your closing costs at closing. And if your loan officer and your real estate agent are on the same page, you can structure it in a way where you get a little bit of that money back, like Brandon mentioned earlier. And then with credit, these programs all have their minimum requirements, right? So this particular Chenoa Fund is usually cut off at 600. So as long as you're over 600 credit score, you should be in the game to qualify for this. And then income is another big one, right? So there are no income limits for this particular program. So regardless of how much you're making individually and as a household, this program should be within striking distance for most people. And then another big requirement for many of these programs are going to be your buyer status. Oftentimes, there are some programs that require you to be a first-time home buyer to qualify for this. This is not one of them. The Chenoa Fund has no first-time requirement at all, so you could be on your second, third, or fourth house and take advantage of this.
Right. That's important. As well, because a lot of people now. I think the underlying thing about that is that you can't have ownership or interest in a property within 3 years, but it doesn't have to be your first house necessarily. So if you had a house, in a previous marriage or something to that effect, and you got divorced and that was years ago, that's fine. It doesn't necessarily have to be your first home, but I don't think you can have interest in the property within 3 years. So you can't currently own a house and get down payment on the second house. That's the rules on that. So DPA, your next step, start with eligibility, then build the purchase price, payment, cash to close strategy around the program. And that's mainly the first step is to apply. Get with us. You could go to one of our websites, applywithb.com, or you could go to the Mortgage Prepper on all socials and go straight to Anthony's website and apply first thing first, and then we'll help you navigate through the actual pre-approval process. Then from there, we could go ahead and pick a strategy that we're going to roll with from there. But it's available if you meet those prerequisites. Of course, you got to get pre-approved first before we go to that step. So everybody is not automatic because I have a 600 credit score. You still have to go through the digital underwriting procedure and get an approval through that digital underwriting as well. So there's steps before you get eligibility. All right. So go ahead.
Before we jump into this next one, what I generally tell people is I've been doing down payment assistance my entire career, over 10 years. Mm-hmm. And in general, there's a rule of thumb. Now, of course, this changes in different locations because your local market will dictate what's normal. But as long as you have enough money to get under contract, which if you're needing earnest money, due diligence, it's called something else in different places. But if you have enough money to get under contract with those deposits, pay for an appraisal, an inspection, and a credit report, you generally have enough money to get in the game. For most people, if you're buying an average size house, if you've got anywhere from $3,000 to $6,000 of your own cash, there are programs out there that we can leverage to supplement the rest that you'll need. So if you're looking for just a number in your mind, obviously the more money you have, the more options you have, right? Cash solves all issues. So obviously you want to have more money at your disposal that gives you more options. But if you've got $3,000 to $5,000, you've got enough to get in the game and at least start talking with the loan officer.
Right. Let's jump into the next. This is some of my favorite programs. Let's talk about the VA loans here. And at one point, I was one of the top in Georgia. I'm licensed in 5 states: Texas, Louisiana, Georgia, and Illinois, and North Carolina. But in Georgia, I was one of the top VA loan officers in Georgia. So VA and USDA offer true 100% financing path Two powerful programs can remove the required down payment when the borrower and property qualify. Of course, you have to qualify for these programs. Both of them have their prerequisites, and we're going to talk about this here. And the main thing is, VA, you obviously have to be military. USDA, you have to be in a rural area. And we're going to dive deep into this in a second here.
Yeah, so for veterans, the VA loan, just like you would think, you have to be an eligible veteran and you have to either be active duty or have had some certain amount of active duty in your military career. And then certain National Guard and Reserve members are also eligible. And then this also applies to surviving spouses, right? Borrowers with a valid certificate of eligibility. So that certificate of eligibility, or a COE, is what the military provides you that tells you what you're eligible for when it comes to your VA home loan benefit. And then obviously there are other requirements. Applicants who meet the lender credit, income, and occupancy standards. Typically for VA loans, you have to plan on living in that property for at least 12 months to be able to leverage a VA loan. And that's the same thing for USDA as well. But for VA loans, typically you have to have a minimum credit score. Usually, sometimes there are lenders that will increase the credit score minimum for their own particular loans that they do. So for example, one lender A may have a 650 credit score minimum for VA loans, whereas the VA doesn't really say you have to have a 650. There are other lenders that can go as low as 520, 500 as far as a credit score, because the VA doesn't have its own specific requirements. But each lender may have their own what we call overlays, which means that they raise the limit, the bare minimum limit, just for their risk tolerance, right? So it's important that when you're looking around and figuring out who you want to do your VA loan with, you find someone that doesn't have a boatload of VA overlays that will make it harder for you to qualify. And that's where Nexa Lending, just to do a shameless plug, we have options for just about over 200 to 300 lenders now, Brandon?
307 last time I checked.
Yeah, and we have plenty of options for VA loans that don't have any crazy overlays that will take whatever the VA says as their minimum.
Right. I mean, that's the thing about brokers are always better at actually getting you qualified because you have more options. Like I tell clients all the time, it's like the difference between going looking at one menu and Uber Eats. As a broker, we're Uber Eats. We have all the menus. So whatever you want, we got it for you. So the only thing about that, if you're dealing with like a banker, you have that one shot at that bank and you're subject to all of their rules. So that's the difference between a banker and a broker. Let's go to the next one. Why VA financing can be so powerful. First of all, it's no down payment. So it's zero down. And I know most people are already formulating in their mind, yes, you can couple this with down payment assistance. So it's already zero down, and you could get a grant as well, and that could go towards your closing costs. No monthly PMI. PMI means private mortgage insurance. What that is that since it's a government loan, they take out insurance policies, FHA, even conventionals backed by the government, Fannie and Freddie, right? They're government entities. They take out these insurance policies in case you default, and you pay for that every month, and it's a premium. So as a VA benefit, you don't pay any monthly PMI. It's automatically backed by the government at no charge. Limited cost. So a lot of things that a lot of fees that normally will occur in a conventional loan or FHA is limited for VA. So that's another thing that's powerful. You have a reusable benefit. So certificate eligibility, you use it, you pay on it, and I got one that's closing on Monday that, this is their second VA loan. They own one right now. They're going to turn that to rental property. They've been living in it for 10 years. Now they have some eligibility left. They're going to take the rest of that eligibility and use it on their new home. So that works as well. So it's a reusable benefit. Occupancy, long as it's your primary residence, you're good to go. You cannot use a VA loan on a secondary home, or an investment property. You have to commit to live there for at least 12 months. Or if you have an existing VA loan, you have to have enough eligibility, and you have to commit to, hey, this is going to be my actual primary residence, and then that existing VA loan is going to be my departing residence. So just FYI.
Yeah. So like we said in the beginning, right, having zero down doesn't mean zero out of pocket. So even if you're going through VA, you still have to have a complete cash to close plan. That means you have to understand that there are certain fees that may either be rolled into the mortgage, or you have to be responsible. Someone has to be responsible for at closing, whether that's you, it can come from a gift from a family member, or it could come from seller concessions, which means the seller has agreed based on your negotiating and what's popular for that market to pay a certain portion of your closing costs, right? So your funding fee is basically for veterans that are not a certain percent disabled. They have a funding fee that is rolled into the loan. Okay, so it's not something you pay out of pocket, it's just rolled into your mortgage. And then also closing costs. Obviously, you have to pay for an appraisal, you have to pay an attorney or a title company to run a title search. And those are third parties that need to be paid at closing. So that's one of their sets of closing costs that you'll have to take care of. And then obviously the appraised value, right? The home is going to be appraised for a certain amount. And hopefully there is no difference in what you're paying for the house and what the house appraises for. If there is, right? If you're paying more than what the house is worth, then there has to be some kind of appraisal gap strategy put in place. And this is where you lean in with your loan officer and your real estate agent to figure out the best strategy to handle that gap, because VA financing says they're going to give you 100% of the home's value or the purchase price, whichever is lower. So if the purchase price is 200, but the home value is 180, then they're only going to give you 100% of that 180. And now you have to figure out how to handle that $20,000 gap. So that's a strategy that you have to kind of dial in with your loan officer. And a good loan officer or mortgage broker is going to prepare you for that strategy before you even get under contract. So you're not flying by the seat of your pants while you've already got your money up for grabs under contract. And then the entitlement, right? Your entitlement is basically what the VA says they will back as far as what portion of the loan they're going to cover for you, right? So if you have full entitlement, that means you're not required to put a down payment down. If you don't have enough entitlement, then that could work its way in so that you actually have to put a small percentage down. Again, these are high level issues that a good loan officer, mortgage broker will walk you through as worst case scenarios. But for the most part, people don't really have to deal with this because they're looking to buy their first property, or it's a property that they're going to be living in. If you're not one of these situations, like I said, sit down with a good loan officer that has experience with VA loans, and they'll create a strategy that makes sure that you're protected.
Gotcha. All right, let's go to the next one. Let's talk about USDA. That could finance 100% as well in eligible areas. This is a program that the government came out with to boost the development of rural areas. So properties in the outskirts of town, that's what they're looking to actually get financing for. And this is the stimulus that they came up with. So this is true 100% financing as well. It's designed to help eligible rural home buyers. So it's in the rural areas only. You could go to the USDA.org map and punch in the address, and then you can see exactly if it's eligible or not, or even a zip code. It got to be in that eligible area, first of all. And then secondly, the income limits may be applicable as well. So in certain counties, you can't, this is not for somebody to buy a $2 million property, that could afford, this is for families that make a certain amount of income, the median income, and that want to have a stimulus to go ahead and populate those areas and develop those areas. So this is supposed to be for a primary residence. It has to be a primary residence as well, and you're going to commit to living there for at least 12 months. And the borrower must be meet all USDA requirements, and we have several of those as well that do USDA loans for us.
Yeah, so as Brandon mentioned, the USDA has two main qualification paths, right? Number one, income and property, right? So income is going to be whether or not you fall underneath that household income limit. And when we say household, that means that regardless of who's actually on the loan or the mortgage, they're going to take into account whoever's working as an adult in that household. So that there is some give or take. There's a catch with some of these programs where if you have an adult child working a full-time job, then their income does count against the household as well, right? And so they're going to do a full income review of whoever's going to be living in the house. And then they're going to also make sure that the property that you're looking at qualifies for that particular area that you're looking to buy in, okay? And obviously, as we mentioned earlier, this is for primary residences. So as long as you can show that you've got a decent enough credit score, you don't make way too much money for that income limit on a household level, and you've got the right property, USDA is well within your grasp.
Gotcha. And then just to add to that, it is a 640 credit score in most states. So 640 is the actual the entry to the ball game right there, should I say. All right. So let's choose the zero down pad that fits the file. So whether it's DPA, FHA, conventional, USDA, or VA, there's DPA programs for all of the above. So that's if you're a first-time home buyer. If you're not a first-time home buyer, if you don't have any interest in the property right now, so you could be eligible if you're above a 600 credit score. VA, if you're eligible for the military community. Let's talk about VA, USDA. If you're interested in moving to the outskirts of your town or in a rural area, that's going to be the path that fits you. So let's get with us, and we'll let you know which paths we'll recommend what path you should go. Right?
Yeah. So it's important to strategize before you start getting out there and looking. And whenever you're talking with a loan officer, it's always important to have a couple of things that you already understand about your particular situation. Number one, you know whether or not you're a military member, right? You also know whether or not the property that you're looking for, your ideal property, is going to be something that's going to be a little bit more rural or have a little bit more land. So these are things that you want to be thinking about when you sit down with the loan officer. The other thing you want to consider too, which is always plug this, no matter what loan program we're talking about, is knowing your own budget. Okay, there are two numbers I tell people to be aware of when you go sit down with the loan officer. Number one, what's your maximum ceiling for payment? Okay, doesn't mean I'm asking you what you want to pay. I'm telling you, I want you to figure out what's the most you can handle per month. That's not going to change your entire lifestyle, right? You want to continue to still live the lifestyle you want. So you have to have that upper limit, right? Not that you have to go there, but it's just nice to have that upper limit. So a good loan officer can use that number, pair it with the second number I'm going to ask you about, and then that'll give you a point to point you to a purchase price that you need to stay under. As long as you stay under that purchase price, you will stay under that payment tolerance limit you have. And the second number, which is going to be how much money do you have to put towards that purchase. Now, we talked about with down payment assistance, you theoretically get into a house between $3,000 and $5,000 down, right? It's not a lot of money, okay? But obviously, the more money you have to put towards the transaction, the better. But as long as you have that number, that 3 to 5K, and then you want to keep your payment underneath this number, a good loan officer will point you to a purchase price that, as long as you stay under, you're not going to have any crazy surprises at closing. You'll know what that payment's going to be. You know what's going to be required to you from you at closing. So as long as you have those two numbers down, sit down with a good loan officer that understands the 100% financing through and through, and we'll create a strategy for you to make sure that this process is smooth as possible and there are no bad surprises at closing.
Gotcha. Actually, those loan officers will be myself or Anthony, the mortgage prepper. I would definitely recommend brokers as opposed to any loan officer, because every loan officer doesn't have the same capability. B, every loan officer doesn't have the same products. And then what you don't know can definitely hurt you. What you don't know can definitely cost you a lot of money as well. So a lot of loan officers just don't know. Don't forget that when you actually get your license, it doesn't teach you the business. It doesn't teach you the products. It just teaches you how to not go to jail. So just because they're licensed doesn't mean that they're competent. So choosing the wrong one can cost you a lot of money. So definitely I recommend a broker. And then even then I would vet that person and see if they know what they're talking about. Most people don't know what they're talking about. And then they put you in the wrong product. It could be a different rate. It could be, you could have saved a whole bunch more money if you get with somebody based on something superficial. So you definitely want to vet them before you commit to a loan officer. So shouldn't be, even though everything that we buy is emotional, this should be more on the logical side.
Yeah, and to add to that is that nowadays what you're seeing is there's a lot of access to being pre-approved online. Okay, I see that all the time, and I have real estate agents call me and say, "Hey, such and such got pre-approved through getpreapproved.com." But then when I sit down and talk to them, there are certain things that a loan officer with experience understands that could be potential hurdles for you down the line versus someone that just, you fill out an application, send a couple of documents, they don't do a deep dive, they don't ask a certain questions that could be deal killers, and now you're walking out there putting money up on offers and getting under contract with a pre-approval that's not going to turn into a closed loan, right? Those are the nightmares you hear online, and it's because people are dealing with people that aren't doing deep dives. If your loan officer doesn't ask you what your budget is, payment and cash to close wise, that's not a good loan officer. If you got pre-approved and you don't know how much money it's going to cost you at closing, or you don't know what that payment's going to look like for the price point you're pre-approved at, you didn't talk to a good loan officer, right? If they didn't do a deep dive on all the programs that you have, at least talk you through it and explain to you why this works or this might not work for you, you don't have a good loan officer.
Let me say one other thing that's for the consumer as well. On that note, and then we're gonna go ahead and let y'all go, and so y'all can share this with your friends. You always can go to the NMLS. That's what we have besides our name, NMLS website, the consumer website, and you always can look up that, take that person's number, that NMLS number on there, and punch that in, and you can look at their history. If they were delivering pizzas last week, no bueno. So that, and then what happens is if you work for a bank, you see that they're licensed everywhere, meaning they're not educated like we are. So a lot of them, if they work for a bank, they're writing and they're doing business off of the bank's number. So they don't have to go through any continuing education. They don't have to pass any tests. They don't have to be bonded. They're working off of, if they work for FDIC, they don't know anything, so they just go through the training that they have inside of their branch, and that's it. There is no national training that they have to go under. So you can look all this up on the NMLS website, and then you know who you're dealing with. So look at their history. How long have they been in business? So on and so forth. If they have any disciplinary action, so on and so forth. You need to know this. So this is all public. This is out there, and inform yourself. So with that being said, let's go ahead and do the outros, and then we can go ahead and get out of here. Again, my name is Brandon B. Dixon. My NMLS is 1541210. I encourage you, go ahead to the NMLS website and look me up. It's at BNL Loan Officer on all social media. Go to my website, www.applywithb.com. If you want to book me for a consultation, or if you want to apply for a mortgage, you call me 832-753-5541. You call me 24/7. And last but not least, you go to www.brandonbdixon.com. If you want to lease, you want to list, don't forget I'm a licensed realtor as well, so on and so forth. Anthony, I got you.
Right. So guys, again, Anthony, I'm super happy that we were able to give you guys this information. And you can always reach me directly on my website, themortgageprepper.com. And I chose the mortgage prepper because you all understand how preparation is key to performance. And if you're not prepared properly, you can run into a really bad situation, especially when it comes to something as important as a mortgage. So make sure you check that website out. I'm in the process of rebuilding it out. So there are going to be a lot of good free resources out there for you guys to use to help plan your process. And then you can always follow me on all the socials, just the Mortgage Prepper on all socials. And if you want to contact me directly, shoot me a text, give me a call. You can reach me at 919-336-0099. We don't have that up yet. We'll get that up there, Brandon. But yeah, like I said, guys, it's all about preparation. If you do the right work up front, this is not as daunting as a process as many people think.
Gotcha. And with that being said, don't forget, drop us a line if you're ready to go ahead and move forward, or at least get some consultation and get set on the right path. With that, we'll see you next time.
All right, guys.